We all well remember transitory. The market might be preparing for a soft landing, but continued signs of Fed hawkishness could mean we're more likely to see negative rather than positive results. Are the markets misreading optimism?
I think investors are seeing and feeling that inflation has peaked. I think they feel in their hearts that interest rates are not going to skyrocket, out of control. I think they feel that the Fed is going to do a couple of moderate raises and then pause and see how things are going. So all in all, I think the market is really becoming comfortable that this will be more of a soft landing than some type of recession that's going to take us over a cliff.
The Fed meeting is right around the corner. Everyone is wondering if they don't necessarily keep hiking rates, maybe they want to hold them. So is a Fed soft landing on the horizon? What will be the result of the February meeting? Is the market overly optimistic on the Fed's next move? What is the real macro picture? In today's video, we're going to take a look at what Lyn Alden has to say on some of the key data points that will help us assess the Fed's progress in achieving a soft landing. Stay tuned until the end of this video as she also discusses the recessionary signals as well as inflation and interest rate impact on the global economy. And if you haven't joined our community yet, be sure to hit that subscribe button for more videos on crypto, the market, and the economy. Let's dive into the video now to hear Lyn Alden's viewpoint on Fed and its attempt at a soft landing.
Well, so it's too early to say because we're not necessarily in a recession yet, although we have kind of pre-recession, warning signs or early recession warning signs. But when you have like a yield curve that's inverted, when you have economic activity slowing down, when you have a purchasing manager index sharply rolling over, all that's pointing towards recession. So I think you can only give them a full grade after the fact. I think we do have enough information though to obviously be critical of the Fed. I mean, they were, talking about how they were going to not even thinking about raising rates, that they were going to hold rates low for years, that any inflation would be, not that big of a deal and transitory. Then you had a massive inflationary spike, and then they suddenly shifted course and started changing everything. And you can imagine how if you're, you're actively managing the price of money, if you're actively managing the ledger that everybody uses, sharp changes like that and flip-flopping your outlook and your what you're calling for can cause quite a lot of disruptions. So I would say that, I think they're obviously their models need updating. I don't think they were dismissive of the sharp growth in broad money supply, saying that that's not going to be a big factor for inflation, where there are a bunch of us saying, no, it's very likely to be, with a mild lag, a big impact on inflation. And so now they have arrested that, they have helped that roll over and solidified that, but now they're doing so generally through the lens of demand destruction. So it's like you out of the frying pan into the fire, and I think they're going to have another issue to go with after over the next year or two.
Once again, markets and the Fed are in a high noon style standoff. A little over a year after the Fed argued that inflation was transitory while markets insisted that rates would have to rise, the roles are now totally reversed. The Fed wants to stay the hiking course. The Fed is widely expected to raise rates at its February meeting, but recently the central bank has signaled a more cautious approach to rate hikes, saying it would monitor developments and be patient in determining the need for further rate increases. This more dovish stance was widely interpreted as an attempt by the Fed to engineer a soft landing, that is, to slow the economy down without triggering a recession. But how successful has the Fed been so far in this effort? I mean, the central bank has been raising interest rates aggressively to try and cool demand and bring down an inflation rate that's remained near a 40-year high. The yearly pace of inflation has cooled, but it's still well above the Federal Reserve's 2% target. Lyn also highlighted that we're not necessarily in a recession right now, though there are pre-recession warning signs everywhere around the globe. Let's hear more from Lyn regarding Fed interest rates and inflation in the next clip. But before jumping ahead, don't forget to give us a big thumbs up on this video. Let's get into it.
A lot of people have been surprised at how much the Fed's been able to tighten. Somewhat me as well. Basically, if you would have asked me a year ago would I think the Fed would get this high this quickly, I would say no, probably not. But if you do it fast enough, you can get away with it for periods of time. I mean, if the Fed just came out and said, interest rates are 7% for one day tomorrow, it's not like all these companies go bankrupt. It's about both the height of that interest, and then it's also about the time spent at that interest level. And that's because a lot of debt is fixed rate. So homeowners have 30-year mortgages, corporations have 5, 10, longer bonds. Government also has a range of maturities averaging 5 or 6 years, but it ranges from almost instant to 30 years. And so when they sharply raise interest rates, that only starts affecting the marginal debt that comes due and then gets refinanced. So if you just leave that interest rate where it is quarter after quarter, that starts to impact more and more and more types of debt, even though you're no longer raising the interest rate. And of course, another factor to consider is not just the nominal rate, but also positive rates, right? So if you look at some emerging markets like Turkey, I mean, if you have, I don't have the numbers in front of me, let's say you had 80% inflation and you had 40% interest rates, is that tight? Of course not, right? So that's very loose. So a less extreme example is that if you have, 7% inflation and you have 5% interest rates, are you tight or are you loose? And the answer is that you're actually pretty loose. And so real yields are still negative in many ways of looking at it. Now, the challenge there is that there's multiple ways to measure real yields because CPI is inherently a lagging indicator. It's backward looking, rates are forward looking. And so it's hard to do that apples to apples comparison. So there's things like, break evens, which are basically ways to measure the market's assessment of forward inflation. But then the problem there is that it's usually very inaccurate. And they were not expecting inflation that we got in 2021, 2022. And so right now, overall, we're still not that tight relative to inflation, although I think we're getting tighter as inflation comes down and as we stay at these tighter levels for longer.
The standoff between the market and the Federal Reserve has been going on for months now, and it doesn't appear to be ending anytime soon. The market is demanding that the Fed provide more stimulus, while the Fed is unwilling to do so without seeing more evidence of a rebound in the economy. This stalemate has led to a lot of volatility in the markets, and it's unclear what's going to happen next. Several officials, including Governor Christopher Waller and Kansas City Fed President Esther George, have hinted at a slowing of hikes in recent days. But inflation has been running above our 2% target for several months. That's why many Fed officials believe that they still have some work to do to get back to their goal. They continue to support further tightening of monetary policy as needed to achieve their inflation objective. So why couldn't the economy resist these higher rates? Let's hear what Lyn Alden has to say on this matter. But before going ahead, be sure to like this video and share.
So again, part of it is that it happens so quickly and it's not had time to fully go through the system. Monetary policy happens with a lag. And so just because interest rates are higher, most debt remains unaffected because most debt is fixed rate and just matures over time. So it's just over quarter after quarter, that'll start playing into interest expense. And another factor is that going back to that Q4 of last year, liquidity change. So as economic indicators slowed down, as the market started to get less hawkish about what they thought the Fed was going to do, that took the edge off the dollar index compared to other currencies, and that's kind of allowed for a rebound. And so, for example, late last year, the treasury market was looking really bad. It was looking increasingly illiquid. Auctions were, treasury auctions were doing really poor. And generally, you get a very strong inverse correlation where if the dollar is strong, the foreign sector is selling treasuries or not buying treasuries. And so all that was kind of a negative loop, causing more and more distress and liquidity problems in the treasury market. But by weakening the dollar, as the market started to say, okay, Powell's not going to be able to raise rates too much more, they started taking the edge off the dollar, and that actually improves the treasury market. Now foreigners can come in and buy some treasuries again, at least stop selling treasuries. And so you have basically this temporary improvement in liquidity that has allowed things to keep going. And kind of the two main components of domestic liquidity, one of them is the Fed's balance sheet, which they're still drawing down. That's the part that hasn't taken a reprieve. It just keeps going down. But the other big one is the Treasury general account. So the Treasury Department holds their cash balance at the Fed, and the Treasury has control over that. They can bring money in, they can put money out based on how much bonds they're issuing, how much they're spending in a given period of time. And ironically, because of the debt ceiling issue, one of the things they're doing to delay the issues caused by the debt ceiling is they can draw down their cash balance and basically spend more into the economy than they're issuing from bonds. And so when they draw that down, that's actually positive for liquidity. And so partly the past quarter, you've had the Fed still draining liquidity with their quantitative tightening, but then you've had the Treasury general account adding to liquidity. And that could happen for a few more months until the Treasury general account runs out. And then that's where I think you get a resumption of probably negative liquidity conditions, assuming the Fed is still able to do quantitative tightening at that point.
Investor psychology is currently dominated by the belief that a pause in Fed tightening is guaranteed to bring an end to this bear market. Yet, viewing final rate hikes from a historical perspective paints a far less optimistic picture. To conclude, year-over-year inflation is still far above 2%, and the unemployment rate is at a half-century low. So, the Fed will probably keep raising rates in early 2023, but much less than in 2022. But what do you guys think? Will we witness dovish or hawkish Fed? Will inflation get better in 2023, and how long will it take to reach back at the 2% inflation goal? Let me know your thoughts in the comments section below. For more videos like this one, be sure to subscribe to my channel. You can also hit that bell icon to never miss out on a single video. And don't forget to like and share. I'll see you guys in the next video. Adios, and thanks for watching Wealthy Value.